Hi guys, I'm super excited to bring you an unexpected second interview with Simon. Just to give you a bit of backstory, Simon is without question one of the best traders in the world no one's ever heard of, if you like. He was able to become profitable after only 9 months of getting into the game, and we talk about in the first interview, if you haven't seen it, I encourage you to watch it, how he actually had a process for that through back testing, forward testing, and creating algos to see how these strategies that he gravitated towards performed over time. Uh, Went on to become profitable after only 9 months, as I say, and has been profitable ever since over that 11-year career. Managed money for clients, was ranked number one signal provider on MyFX book, which ultimately puts him in the highest echelons of the trading elite. Certainly from the perspective of someone who did it off their own back from home, which is what I know many of you are obviously trying to achieve. Simon has a win percentage of in and around 81%, which is extraordinarily good. And what essentially happened after our first interview, just to sort of lay this up for you guys, we went back and forth on email and just discussed how much we enjoyed the interaction, and he actually wanted to share more information. He wished he'd shared more information. So I said, would you mind doing another interview? To which he very graciously agreed, and not only that, he wanted to go even further than that and actually share with you some of his tactics and strategies that have made him the trader that he is with you in great detail, to which I was, I have to confess, slightly flabbergasted, because traders tend to be very cautious of sharing their strategy for fear that somehow their edge will dissipate if loads of people start trading it. I'm of the abundance type mindset, and I think Simon is too. You know, you can tell people your strategies, but ultimately you've got to be able to then implement them and stick to them and cope with the emotional side of trading, etc. So it's not as simple as just saying, oh, well, if you share it, it's not going to work anymore. And Simon's already had a successful career, so I'm guessing it won't impact him too much anyway. And he was very gracious in what he has shared with you. He's actually gone and shared the strategy. He talks about two strategies. He's actually gone and shared the MyFX book that was rated number one on MyFX book, and he stopped providing those signal services for other reasons, but he was the number one provider on MyFX book, which literally puts him in, as I said, that top percentile of the best traders in the world. So I hope you enjoy what you're about to learn. The format is Simon goes into the chart straight away, and then what we do after that is we chew the fat and talk and discuss what he talked about within the analysis on the charts, and I hope you find that very helpful as well. So sit back, relax, and really enjoy this experience, because not many traders do what Simon's about to do.
Something that helped my trading quite a lot was a mean reversion strategy that I did, which basically means that price comes back to the average quite often. And something that I discovered quite a long time ago did turn me into quite, probably my most profitable trading strategy over the years. I've tweaked it a little bit so that that it has become more optimized now in recent times. And I put it out to a company to monitor my account, my live account with it running on, which is called MyFX book, and they printed the results of it. And even going back to last year, when they've been running for a few months, it was ranked as number one trading strategy on their website. So it shows it still has merits. It still is as profitable and more profitable even than what it used to be, even with the changes that have happened in the market. So I'll just show you a little bit about it. I won't give absolutely all the details, because it's obviously there's a few variations to it which would be too much to go into in this, but you better see pretty much what the premise is. So Euro GB, what I'm looking for is pairs that are fairly well correlated together. So the euro and the British pound over the years have been pretty well correlated. The Aussie dollar, New Zealand dollar, they have been as well, and other things like commodity-based combinations are very useful to trade as well. But not every trading pair is successful with this, or as successful as other ones, but certainly more correlated ones tend to show this mean reversion very strongly. So what I'll do is set it up. I use envelopes, which I will do now. Yep, 5-period moving average exponential with a deviation on there. I use the daily chart. That's a little bit too busy. There we go. Then I'll add in a moving average, which is the 5 exponential. And you should better see that running through the middle of the screen, the middle of the price bars. The envelopes just literally mimic, if you have not come across them before, the 5 moving average or whatever moving average you're using. This one here, that's mimicked just a difference away, which is called the deviation away from that point, and that can be adjusted depending on how volatile the markets are. What I look for is a move outside of that envelope. So you can see most of the price action is within it, within these envelopes, but when you get this one, this is quite recent, this was only just a few days ago, we had a spike up that broke through the envelope. At that point, I'm looking to take a sell trade to bring it back to the center, the moving average here. So quite similar to Bollinger Band type strategies, only we don't get some big expansions and contractions of the envelopes. They do mimic the actual center line. So that one there would have been a good trade. If you see what that would have been, it probably would have entered about there-ish and would have got out about there. So 58 pips in a day. Fairly straightforward, just looking for this sort of unusual price action that takes it outside, further away from the norm than it would do normally. So if we go back, let's see what we've got. If we go back over the period of time, we'll see another period here. Now, what we want is really a period where the markets are range bound more than trending, which is good because markets tend to be range bound. They tend to be that more than sort of 70% of the time. So you're going to have a lot of chances to take these trades. You can see one here, poked above the line and would have come down pretty quickly to probably get another 50 odd pips there. The day before could have had that one there, might not have triggered there because the envelope might have been a bit lower than this, but if we did, then that would have been a lovely trade because that would have very quickly got you 70 pips on that. We take it further back, and this is a fairly strong downtrend, which is not ideal for this sort of strategy, but you can see that still the price action is kept within the envelope. So when it did poke out below here, we could have been in the trading strategy and we'd have probably been stopped out, not stopped out rather, we probably would have been a break-even-ish trade when the price comes back to the center moving average. Then later on, a couple of days later, we've got another one here, which obviously would have been nicely profitable, 46 pips. And again here, another one here, which would have been 60 odd pips there. So I tend to use quite a decent, healthy stop loss on this so that it wouldn't be triggered at this sort of time. You know, we've had plenty of time to run on this and just take the profit when it hits this center line, the moving average. And you can see over time, you get there's lots and lots of opportunity here on a daily price bar to get some significant pips on a very regular basis. If we take it back further, I mean, this is even better now because we've got huge amounts of opportunity here and here and here. You see, all of these would be profitable trades. We wouldn't have had a loser on any of these at all. All of these would have been very nicely profitable. Big, some of them quite serious pip counts as well. I mean, that's 67 pips in very no time at all. There's a good one here, which would have spiked down to there. That would have been 84 pips. These are pretty good, consistent trades. That's what I like. I like to see consistent trades. On Euro GB, 1 year I had I do alter the distance, the deviations it's called, between the centre moving average and the envelope. I do move that occasionally. Well, not occasionally. I do move it on based on volume of the market and the power of the market, but I don't move it hugely. But on a whole year, I had a whole year 1 year without a single losing trade on this, which was quite pleasing, obviously. Bad times are when you get this sort of situation. We get a really strong down trending market, really strong, powerful bars. You can be struggling there a little bit with. It's poked out below here. You probably would have been in somewhere here. You might have got away with this one because the price did come back up, obviously up to here. So the chances are you would have taken a small profit on that and a small profit on that one as well. This one here might have been a little bit of a loss. Came down, yeah, it might well have been to probably here. So I might have taken a 50 pip hit there. But in all of this move across that I've just gone through, that's the only losing trade would have had, and then quickly it would have been back into profits again. There's 50 pips there, recovered the next day, and this one here, that would have been in straight away because that market entered below the envelope, so you can enter that straight away, and you'd have been in. Well, I might have been to this one here, 70 odd pips as a strategy. So even with that strong down move, overall we'd have still ended up well up on pips. And when it's a gentle move like this, rather than the very strong move down, then it keeps on reverting back to the center line, and it allows you to get the pips that you want on it. So that's pretty much it. You can refine it, obviously, and it is. I have optimized and refined it, and I don't just jump in purely when it hits the line. Although you can do, as you can see, it does. It is very profitable. If we take this last one here, this last bit of price action here, we'll go down to a smaller time frame, so let's say a 15-minute. Have a look at it. Bear with me. So this is the spike up. This is where we triggered through the line, although you can't see it now because it's gone down to a different time frame. You can look then, once so spike through, you'd be up outside of the top of the envelope. You can then look, if you like, for a candle which would give you an entry. This sort of filters out some of the ones where the price keeps on going up higher or goes down further and further away from the envelope. You wait for some price action, it gives you an entry. And this nice 15-minute bar here is a very bearish candle. Yeah, big wick, big shadow above. It gives you a chance to enter at this point, and then away it goes. You don't have to do that, but it just filters out some of the bigger price moves away, and maybe allows you to keep the stop loss a little bit closer in. For those of you who don't like having the wide stop losses, already mentioned, it doesn't really worry me too much because I'm quite happy to let the trades run. But for those of you who like having sort of tight stop losses, then let's look for some different reasons to get in, or some more confirmation it's going to turn back in your favour, and that would be a good one there. So I hope that helps on that. Now, I think what we'll do is have a look at how I set up the charts for my main trading, the main manual trading that I do. That envelopes trades there, I've got that automated. I've built an algorithm for that, and that just trades in the background for me, and I don't have to think about that at all, apart from making sure it's working and switched on and the internet's connected. So that's a nice easy one to go. But this is the ones that I do for the manual trade, and what I look for and price action, the way I set up my charts for that, and I hope it's of some benefit to you. It's not the only way of doing it by obviously any stretch of imagination, but it's one that I find works for me. So we'll go to Euro US dollar. It is a very popular pair, obviously one of the most traded pairs. So and it's got the lowest, obviously the tightest spreads, so a lot of people do trade it. Let's go to a daily chart, have a look to see what we're doing. You can see in recent times, as a daily chart, we've been in a pretty big downtrend. We've had an uptrend, or big uptrend, bit of correction, uptrend, consolidation, downtrend. Okay. What I'll look at now is how we could have possibly got into and where I did get into this downtrend. That consolidation, you've got, it's obviously range bound here to here, with a little bit of poking out below. I will put on I use an 89 exponential moving average, so I'll just pop that on, which gives me an idea about which direction I really want to be trading the markets. And as you can see, I'll be trading up at this time and then down at this time here. Not quite as straightforward and simple as that, but that's a pretty good guide. I found the 89 moving average, exponential moving average, is pretty reliable on this. So we've got this range bound area here. I will go into a different. You can see at this point it's turned below the 89 moving average and turned into a down move. So I'll go back to this point here on the hourly chart, which is here. You can see this, all this range bound action here before it dropped down below, dropped out of this range and went into the very steep down, well, steep downtrend, but a downtrend, which wants to get in. Now, I wanted to get into this trade. I've been waiting to get into this trade for quite a while, and I was trading it within the range because I was getting price action which told me it wasn't really ready to break below or above it. If we look at the down side, this is the bottom of the range, this red line here. It's obviously being respected here quite nicely. It's tried to get below, well, it's just a little poke below, but you see the candles are very sharp, very quick move below, and no real force in them, no real information that gave me the thought that it was going to go down at this time. So I was buying at these bottoms here and making some decent pips, particularly when it goes above the 89 moving average, comes back down, rounds back down, and buys off it. So it's got some compliments there. It's come off the bottom of the range, it's gone through the 89, come back down to test it again, and off it goes. The difference, can you see the difference here between this? It comes out at the end of through the bottom of this range here and moves very gently, beautifully round in a lovely curve here. Very different to this spiky up and down that tends to say that it's wanting to go back up again. This here is far more interesting to me. This is what I look for. Big curve move. It goes then down, some nice bearish price action that confirms the fact that this could be, at this time, a sell-off. It could be a proper break of this here. It could be a stop run. We don't know at this time. And obviously Mark, his strategy allows you to wait and see whether it is one. And this strategy will do as well, because there's a nice curve there. I'm thinking this has got a good chance of going down. It's underneath the 89 moving average. It's broken out beautifully in the fact that we get some nice bearish candles here. And as soon as we get below this level here, now I'm thinking that's a very, very good chance that this is now going to go down, and I want to be selling this. Again, a little bit of a curve back up, a good big candle trying to get back up, but it got nowhere near back into the range, and the 89 moving average held. Next bearish candle, I was in at that point there. I was in on that candle. So if I can get that a bit closer, because I know the screen's obviously quite small. Yeah. So yeah, we had that big strong candle there. I was in the trade at that point there, because big strong candle going up that didn't break back into the range, followed immediately by a down candle. So that's telling me that this wants to go down, and there I was, sold it nicely. If we look at this downtrend now, see how lovely and smooth it is. It curls back towards the 89, curls back. There's lots of opportunity. If you miss this first one, there's lots of opportunities to get in. The price action is very smooth, very, very similar sized candles. It's not telling you that it's going to be doing anything other than going down. It's going to maintain its move down. Nothing at all of any interest at all to say that it's going to go up. So you can be selling this down all the way down, you can get it in on regular bites, or you can just stay in the trade and stay all the way down until it's lower. Then we get a change, and this is really what I look for. This is absolutely the key part of what I look for on support and resistance levels, supply and demand levels, everything, is when the market changes. And again, this here is when it does. I'll actually go back to that other one, you can see it better on this. At no time have we had a significant retrace on the way down here. No time whatsoever. First time we do is from this point here. We get up and we've got higher highs, higher lows, higher highs, higher lows, higher high, higher lows, higher high. This is a significant retrace. It's got above the 89 again. It doesn't mean it's going to reverse and go back up again, but it's a significant retrace. And so this point here is absolutely key to me. And I will mark that. I'm interested in what was the last down move. So the last down move that caused this expansion up is there. I'll get it right in a second. Right, okay. So that down move there caused, well not caused, but it was a big area that led to this buying. So that is key to me. So I want to make sure I know where that is going forward and use it in my future trading. So I'll move it on forward. Just bear with me a second while I put this in, because this is very important. To the end, okay. So what we can see from this is that price has come off this area. It's done the retrace, it comes back down and doesn't get through this area of support. It's trying to. What it takes is a big bar to break through it. Once it's done a big bar to do that, then again that says to me that the market wants to go down. It wants to go down further. It's already gone down a fair distance, retraced a bit, and now it wants to go down further. So I'm waiting for a retest of that area, so a curve round, and to get back in at some time here, or more probably here. The reason being, this is a much nicer curve with small candles, not too aggressive at all. Like this one's a little bit aggressive, a little bit sharp. This is much more of a curve. It's come back up. It's quite close to the 89 moving average. As soon as we get bearish action, now I am looking to sell it. So I'll be selling on that candle there, probably either one of those two there at the start of those. And again, you've got a nice move down as part of 100 pips on the way down there that you can take. Now that area here is of interest as well, because now again we've got another significant retrace back up. So at least an ABC pattern. It's broken a bit of structure. It's gone through the 89 moving average, so that's a significant retrace again. So I want to put in that area. So the down move that caused or led to the up move is there. So from there down to there. And then through to current day. Okay, so just putting those two in there gives me an idea about what's going to happen, or where areas of supply and demand or support and resistance are. And they are zones. They're not lines. I'm not interested in lines, because there's far too much money being spent, and so in certain areas that means they can't get filled all at one level. They will get filled over a period of that within a zone rather than one particular line, which I think is where people often go wrong. They think that support and resistance has been broken. If price comes back up, they think this is a bottom here. If price comes up through that, oh, it's been broken and no good. But no, it's within the zone. As far as I'm concerned, it can still come down off that. And here's great ones here, because we're still looking. Can you see how this one's been respected, and then it's taken this big candle, which is what we want to see, to get through it. And so again, now this is saying I want to go down further. The market wants to go down further. Nice rounded retest, good back up here of having the 89 moving average again for confluence, and again now we can sell off and make some money. Great one again here. This is a good old school trade here. This zone's obviously being respected very well. Got a big sell-off. If we don't get it, then okay, it's a shame, because it was a good one, because we've got confluence there. As soon as it came back below it, we could be looking to get in. A lovely sell-off. But then what happened? We had this area of consolidation, which this is a classic pole and flag situation. So take this to the edge of the screen. When you're looking at it here, pole coming down, flag going across, the chances are it's going to break out the bottom of this consolidation area. That's what happens more often than going back up the other way. So this is real old school trading, this one. So if we have a line in there, so this is your area that you're looking to get in below, breaks down below, and you'd be in. What is interesting about these, I'm sure most of you will have seen these, but from the top to the bottom of the area of consolidation is 92 pips. I'm sure if we take it from the bottom here down to the bottom here, 94, 96, well, it's a bit high there, but so about 94 pips. So very similar. These moves here, when you've had that move down, had the area consolidation, very often breaks down almost exactly the amount that it actually came down in the first place. So that's a good way of actually picking your target, so you know that you've got a target where you're expecting to go to on that. Very high probability trade as well, that one, particularly when you're in a downtrend, you're below the 89 moving average, you're below this period, this resistance area. It was support, then it became resistance. Very high probability trade. Then it curls back up, and so now we have another area of that I'm interested in. So what was the down move, the last down move that caused this, or led to this up move? So I've got it there. Let's put another rectangle in. It's there. I'll move it across again. Okay. Come back to this position. It's bounced off here. We wouldn't necessarily know it's going to bounce up this high, but it's retested the 89. So you could take a long trade there. It doesn't like going through the 89, so you could be taking trades here until it reaches this area of resistance again. And then comes down. If it's going to be a change to an uptrend, then we need it to burst through this area of resistance. It's showing some quite big, significant bullish action. Another pole trade here, actually. Look. Yeah. But and what happens is a big bar again to break through. So it's broken through, it's supported from there. So now we know that we're likely to be going, looking for buy trades, long trades now, rather than sells. Wait for it to come down into this resistance area, support area. If it's got some complements, then great. You can wait for it to go back above the 89 and then take the trade, knowing that your target is this area of resistance up here. It keeps on doing it. It keeps on doing it until it gets this big sell-off, which is, this was all to do with the FOMC and ECB last week. FOMC saying that they were going to hike interest rates 4 times this year, which is previously they were saying 3, so that sort of strengthens the dollar. And the ECB was saying they've been a little bit more cautious than what they had been in the past, and so that tends to lead to a big move, which is what this is, and of course burst through this this area. But where did it come down to? It came down to one of my blue zones here, one of my support zones that I've put in, and it's supported off it, and it's come down again to it, and now it's being supported off it again. I mean, I'm actually quite bullish on this pair actually, and I would like it to show me good price action to go long on this, and I probably want to see it get above this area here, because if we look back, I can just take it down a bit so we can see it. This stopped here at that area, which we had this lovely pole trade here, this area of supply and demand, and where we've got some liquidity here. So it's gone up to that area. It hasn't broken through it, sold off it. So I'd really like to see this price come back up, get above the 89 moving average, break through this area here, do a rounded retest of it, and then go back up. And when it does, if it does that, then things that lead me to believe that it's likely to happen are that the market doesn't like this type of action. This sort of trade here, this is too fast. It needs to be retraced. It has been retraced a bit, but it needs to be retraced a bit more than that, really. It's just too fast a move. These candles haven't been retraced at all. Normally, every candle that you look at will be retraced about 50% or more. This one has been retraced, what, 20%? This one, 10%? Nothing at all on there. This one, 5% probably on this candle. So realistically, it's got a good chance, the market has got a good chance to come up to 50% on this candle across here at some time. We won't do it all in one move, we won't do it quickly necessarily, but that's what leads me to believe that it's got a good chance of going up. Again, it's being supported as well here. Price action starting to go in our favour. We're getting some big wicks down below, so this could be, I could be now looking at, particularly if we get a nice sort of gentle rounded retest of that, I might be taking a long trade on this. But more cautious approach would be let it come up, go above this area, above the 89 moving average, round, retest it, and then off you go. So I hope that helps. It's really plotting these. It's amazing how, going back quite a long way, this very first area here, well, not there, sorry, there, the first retrace has been respected time and time and time again. Even when it comes back, when it's gone down an awful long way and it's coming back up the price, it comes back up and respects it again. And it only, if that had got above that and tested it, then we could have been away and going north. This is going to act like a pivot. But at the minute, this one's acting like a pivot. Anything below this zone, we're selling. Anything above, we're buying pretty much, as long as we've got some confluence with moving averages and the like. So again, hope that helps, and I'll leave you to your trading, and hope you make lots and lots of pips. Cheers, thank you. Bye-bye.
Thank you very much. It was very kind of you to share all of that brilliant stuff.
No, pleasure, mate. Pleasure. No, I mean, it just hopefully gives somebody a bit of a help anyway, and if it does, then great. Yeah.
Yeah, absolutely. Yeah, I mean, there's gems of wisdom in there that people wouldn't come across in a lifetime. Um, One in particular, which I'm really interested in, is the way that you specified those zones, those levels. You are essentially separating. You know, you're not just selecting any sort of level in isolation. You're actually saying, no, hang on. If we get some type of strong retracement off this level, then essentially, if it then follows that, if it's in a down move, if it then breaks that level with a strong move down, the supply demand equation's changed when it reverses back into that level. Essentially, is that the thinking
Yeah.
behind it?
Yeah, absolutely. Yeah. I mean, I want it to be a strong level or a strong zone, really, and so that has to be a decent retracement off that, and then if it gets proved by price bouncing off that, probably again in the downtrend, if it bounces off it and goes north again and bounces off, it goes north and then bounces through, sorry, not bounces, if it goes through with a strong move, then as you say, I think the bias has changed from bouncing off going north to actually then it's going to be turned from being a support to resistance, and you're looking to sell it off. But only if you get the right move. I always look for these big candles that go through those zones to tell me that, yeah, the market definitely does want to go down, and then some retesting of that, and away it goes.
So you've actually sort of come across or witnessed yourself the fact that there's these nuanced signals in these particular locations on a chart that is actually telling you that something's changed. Was that by chance, or was that just experience? How did that come about?
I don't know now. I think because going back a while, I started to look at zones rather than being, actually lines of levels of support and resistance. And once I started
Right.
looking at that, I thought, what is making it? What is making the size of that zone? And so then I've sort of built on that to try and determine what the top and bottom of that zone would be, and then I suppose looking at it, I'm sure I must have been just looking at it and thinking the only reason why it's changed or gone from being a support to resistance is because it has broken through with a strong effort. Basically that has just shown me that it's really determined to actually change its bias. Very rarely will you ever get one of these zones sort of broken through with just really poor, very weak price action that just gradually creeps through it. It very rarely does. And so if it's poor, weak price action, then the chances are it's still going to be acting as the original, whether it's support or resistance. But as soon as it's strong and bursts through, then it changes.
Right, that's interesting. And ultimately, big money essentially can't hide its tracks, can it? It
No,
leaves clues.
yeah, and absolutely. And this has happened for a long time. I mean, once the big money does come in, then, it's going to move the market, isn't it? And so you're going to
Yeah.
see it, even if they do add it in over, scale in over a period of time, it's still going to to create a big move that you can see. And if it breaks through one of your areas of support and resistance, then I'm taking note of that.
Okay. And imagine you've got a situation where price bounces and seems to be a demand or supply zone. Do you have any preference about how big that retracement is, or are you using the 89 moving average and to sort of look at it and say, if we're above there, that's a decent retracement? Or are you considering
Now,
fibs or?
no, I mean, fibs do come in. I didn't touch on that because I thought it was going to get a bit too complicated. We brought those into it, and trend lines as well, because I do have trend lines as well on my chart, but not too many of them. But the main thing is it a significant retracement? Has it actually done an ABC pattern at least? And has it broken previous structure? So has it gone on a down move? Has it bounced up higher than the previous sort of swing high? Not swing high, but previous, sort of peak as such.
Yeah.
And if it does that, then that's a significant retracement, and I'm taking note of where that started from.
Okay. Okay, that's brilliant. And On the use of the 89, was there any particular reason for that? Because it's what you've done. How it seems to me is you've got this amalgamation of different concepts that have completely blended with themselves, so that you know when you should be going long and you know when you should be going short, and that's those levels, and that's the moving average. Was there anything? Was it just by chance, or did you test
Yeah,
it?
I mean, I did see it wasn't me that sort of came up with 89. It was somebody I saw years ago that was using it, and like anything, I thought 89. That seems a bit odd. Why does that work? Or does it work? And so I sort of tested it, and I thought actually, this is quite interesting. It looks like it has got merit. And it seems to be quite consistent across different time frames, which is good. I don't like sort of change and jump between moving averages for different time frames, and I've not always used moving averages. But this one just gives me an idea that if it's below it, then I'm looking to be short, assuming that other things are in complement, and if it's above, price is above it, then I'm looking to go long. So yeah.
As simple as that.
Yeah, I mean, it's
Brilliant.
not quite. Yeah, it's not as simple as that.
Yeah,
But
not quite as simple as that,
particularly
but
because it's, I will look at the daily more than anything on this, and so that gives me the overall direction of it. But within that, there's going to be quite big, significant retracements that I can take advantage of if it looks good. So I
okay.
will take advantage of those as well and do a bit of a counter trend trade at times. Yeah.
Okay, and just finally on the 89, the reason why a lot of people struggle with the old 200 moving average sort of idea is that there's a hell of a retracement or stroke reversal
Yeah.
occurred before you know that your bias has shifted. If you're just using that moving average on its own, this seems to be more responsive
Yeah, it's more
to those.
responsive, but still fairly accurate. And that's what you want. Obviously, it's not going to be perfect by any stretch of the imagination, but it's another tool to use to give you a clue that if everything else is in order, then this helps a lot, and then the price does bounce off it a lot, so it's good.
Okay. And when you talk about those counter trend moves, are you wanting to see those overextensions, like that example in that we just finished up with there on the chart, where you had lots of selling into a level, very little retracement? Is that something where you would consider the counter back to maybe the 89 or some structure?
Yeah, possibly on that. What I'd like to see is make sure that I've probably got some of these zones already up where we've proved that they provided some support in the past on
Right.
a down move, and then once the price comes into those support areas and it looks like it's not going to burst through them, not got a lot of big price action going on downwards, then I think I might take this move back up for a while, particularly if it's overdue. A lot of people use RSI and stochastics and all that sort of. I never do, but I'm sure that might be able to be used on this to say when you could get in as well and when you could get out. But I never really look at those, to be honest.
Right. Okay. Fascinating stuff. Let me just. Okay. So you mentioned the rounded retest a little bit in terms
Yeah.
of that would be something that you would look for a potential entry. It's not more aggressive. Is that essentially the reason for it? You've just
Yeah.
noticed it.
Yeah. It's just once it seems to be more successful. Over the years, I've noticed that if it just gradually comes back in on a nice rounded loop back into that area and retests it, then it's more likely that it's going to bounce off that down or whichever way it is. Whereas if it's quite spiky, bigger candle action, then it could go either way. And I'm not really interested in that. I'd rather have things on my side, and that rounded action just gives me that a little bit of extra edge, I think.
Fantastic. Absolutely brilliant. Well, that's sort of you covered in great detail the trend strategy. Yeah, actually, just one more question on that, Simon. You know the level, once you've identified it,
Yeah.
do you hit it up more than once, or do you consider that first moment the optimum moment, and you kind of just use it as for some perspective going forward, or do you
No.
actually hit it up again?
Use it going forward as well. It's I mean, I've used levels that have been on there for 2 years.
Wow. Okay.
It's not. I'm not. At some time it will be give me a fake, and that's fine, and that's possibly where we can use your sort of type of strategy to come into play. But if it's amazing how long they go for and still be relevant.
Right. Okay. And then you're just looking for that strong break either side for that confirmation it's changed. Okay. Right. Okay.
I mean, I'll trade it bouncing off it for a period of time. There's not a problem. But once it's changed its bias, then I'm looking for the other direction.
In terms of stop loss management of that scenario, then, so you ultimately have a fair amount, potentially a fair amount of structure there, telling you, you're comfortable in the trade. From what moment after entry, imagine something changes and the price then starts going against that structure. How much will you give it the zone before you kill it, or will you give it the structure? How much do you sort of hold on to it if it goes instantly against you?
Mostly it'll be the zone. So if it's come out in the bottom end of the zone or whatever, when I want it to carry on going north, then I'm thinking this is almost certainly going to, I've picked this wrong, so it's invalidated the trade. If it does, it can spike through, and if it comes back quickly, then fine. Then I don't count that as an invalidation. And so I wouldn't have a stop that's really tight behind the zone, but I would be aware and I'll be watching that price action. And if it looks like it's going to stay below that zone with a bit of that gentle sort of price action, retesting it and that, then I'll get out the trade.
Okay. Brilliant. Thank you very much. Very generous of you. That's wonderful information. So just quickly going back to the previous setup that you mentioned, the first one. So this is super interesting. So this was actually the top signal strategy. You were the top signal provider for a period on MyFX book with this strategy.
Yeah, absolutely. Yeah, which was quite nice. Yeah, it was. I must admit, it was quite good for the ego to see that there. But and a relatively simple strategy, because although that wasn't absolutely everything about it in that that synopsis I gave you of it, it was pretty damn close. It was only small tweaks on there that would have that made it a little bit more predictable, and so it was the number one strategy.
Wow. Well, if that doesn't give people pause for thought to double down on listening to the videos and the presentation that you was given, I don't know what would. So with that strategy then, Simon, so there are some obvious ways to maybe improve upon just the basics of what is obviously a very profitable strategy anyway.
Yeah.
So things like levels of support and resistance.
Absolutely.
Right, okay.
Yeah, you can even put in moving averages into there, Fibonacci levels, support and resistance levels, put those in, and then if you get a confluence of those and an extension above or below the envelope, then you've got a very, very good chance that it's going to go in your direction. So that would definitely improve your the level of consistency of it without question.
Right.
But you're going to miss out on quite a few trades that way. So whether it's more profitable in the long run, I don't know if it would be, but certainly if I see it, an area there, then I'll not only just let the robot do it, or the algorithm take the trade, then I might take the trade as well manually and sort of double up on it, because I'm thinking I'm going to take advantage of this and make some money.
Okay. And you mentioned that sometimes you adjust the standard deviation of the envelopes. For those people who don't know, that's essentially implying that volatility is increased, and you just want to enter a little bit more of an optimum moment. How do you understand that that's changed? Are you looking at ATR differences?
Yeah, I think ATR is the simple one, and that's one of the measures I use is ATR, which. Obviously, if the price range is bigger on a daily basis, then the envelopes can afford to be further away or need to be further away. The deviation of the envelopes need to be further away from the average before price is triggered. Before a trade is triggered, because otherwise they can just be hit on just regular normal day movements, which are not what we're looking for. We're looking for an exceptional movement that will hit that envelope, or an extension outside of what would be the norm, and it needs to be obviously wider. If the daily range average daily range is higher, then it needs to be a wider deviation on the envelopes. And it varies from one instrument to another. So one forex pair is going to have a 0.6 average of deviation, and another one will have 0.8. And that needs to be just tested. And I know what they are. I've done it all over the years, so I know what they are, and so I can have the algorithm automatically put those in. But other people would need to do all the testing to see which ones work best with each currency pair.
Yeah, of course. That's brilliant. So in many ways that's kind of a stop hunt strategy, isn't it? Just sort of thinking about it.
Yeah, it is. Yeah, absolutely. Yeah, you're taking price away from the norm, particularly when you're in a consolidation pattern, and you've got a range-bound area. Then if you get a little deviation outside of it, then the chances are you're going to see a fairly big move back. It could easily take the stops and actually make the trade a lot better.
A lot better, yeah. So you mentioned the range-bound element, and for those who don't know, the markets, I don't know for certain on this, but the suggested number is 80% of the time. It's probably not perfectly 80% of the time, obviously, but 80% of the time it's range-bound. Do you have any considerations of what constitutes a range? So is it for you 2 touches on the top edge, 2 on the bottom, or is it more than that? Or
no, I've got no issue at all about it. All I do is I limit the amount of trades that the algorithm will trigger on a daily basis, and so that sounds a bit strange way of going about things, but what that does is then if it triggers 3 trades in a row on each day, then the chances are you've got a trending market there, because it's being extended down through and it's still starting to trend. And so I'm going to get rid of that. I won't add another trading at that time.
Right, I see what you're saying.
So I'm filtered. So I'm not looking for particularly the ranges or the actual consolidation area at all, and tops and bottoms of it. Not interested at all. It's just really what happens with price. Does it trigger enough trades? And if it does, then I'm stopping. That's it. Those 3 will do for the time being until it comes back into a range-bound area.
Okay. And if you were manually doing that, Sam, in terms of managing downside, imagine you've got like a spike up through the level, the top edge, and you're watching it manually, and so this is all on a daily chart.
Yeah.
You then get a close above that prior high or low. Is that the moment in which you would nix it and move on?
Nearly always.
If you were doing it manually?
Yeah, I've nearly always wait until it hits the moving average. So the actual centre line, effectively, of the envelopes. I would wait until that, unless there's a good reason not to do. I mean, and there are some good reasons for that, because there could be very strong areas of support and resistance that it means the price is unlikely to get to that far. So I would close the trade earlier on that if I was manually trading it. But I'm quite happy for it to do its thing and reach the centre area most of the time.
Okay, brilliant. The only other thing I was going to ask is, in terms of this strategy, but the envelopes, I don't think they're a standard thing in MT4, are they, as an indicator? Do you have any recollection?
I think they are. I think they are. Yes. I mean, I don't think I've added them in, because most of the time when I put a new demo account on or anything like that, they're normally there, I would have thought. But they're under trend.
Ah, yes, I see them. Got you. Got you. Okay. I can't remember off the top of my head what your settings were for that. Was it
5? I'd use a 5 exponential on it, and then deviation obviously varies from what pair it is and what the volatility of it is, of the current volatility of that pair is.
Got you. Yeah, I've got it now. Brilliant. Wonderful. Good stuff. Is there anything you want to add, Simon? No?
Yeah, I think probably just not subjected to that. It's just I mentioned to you before that I probably should have said in the first interview that people should document the trades, and every trade they take is a fantastic way of optimizing your strategy and making what might be a very ordinary strategy into a very profitable one. because it might show up if you're putting down all the details about time, the day, the date, what any levels that you were being triggered on certain indicators you're using or whatever, and what your stop was and all the rest. If you're doing all that, then you can, after you've had 20, 30, 40, 50 trades, you can analyse those and see, hang on a minute, I'm getting no winners on a Monday or Friday. Tuesday, Wednesday, Thursday are brilliant. So, I mean, they're very different markets. Monday and Friday are unusual. You've obviously got square up day on Friday and the market opening on Monday. So Tuesday, Wednesday, Thursday often have very different, price action to those, end of the day, end of week days. And that can, it can highlight that, which you wouldn't get if you didn't actually document all the information down. It's absolutely key to do so. I've changed strategies from being, as I said, very, very ordinary strategies into very profitable ones over the years, just purely by looking back and analysing what, the information that's in my trade list.
Allowed you to optimise. Brilliant.
Yeah.
Awesome stuff. So I just wanted to quickly just go over a couple of more general points, if I may, some questions that I hope you don't mind me asking, and we'll wrap it up. Good stuff. You mentioned way back in the beginning where you were managing investments for your doctor clients. I'm just interested. Did you ever go on to manage money for those guys once you became a professional trader? Or?
Yes. Yeah, I did. Yeah, and. They would keep. We had a good working relationship and almost became friends, I suppose. And they trusted what I was saying to them and the reasons why I was getting out of the industry. And they pretty much said, "Well, can you look after some for me?" And so, on a power of attorney basis, then yes, we did that.
You did that, and I just wanted to ask you, how did you have any challenges? So obviously our first challenge about the psychology of trading is dealing with our own issues, right?
Yeah.
But when you manage money for people, you've then what I found is you then have a completely different set of problems.
Agreed.
Can you just talk to me a little bit about that and how you managed to cope with it and what those issues were specifically?
No, they are very different. It's all right having your own money that's going down, but having somebody else's that's losing money is a very different thing altogether, and it can play on your mind. It did play on my mind. I didn't like it at all whenever I went through a period of losing 2 or 3 trades in a row that hit people's account sizes and that, and I kept on thinking about what they would be thinking at that time, rather than just bothered about what I was doing and making sure I was doing the right things and continuing. I was actually bothered about what they were thinking, and which was really silly. But it's far more important when it's somebody else's money than it is your own for some reason. And I did find it quite tricky. Over a period of time, then people realised that there were going to be times where you had a little bit of a drawdown, but overall things were very profitable, and so therefore it became less of a problem. But it nearly always is a problem it nearly always was a problem at the start when I first started trading with that person. Then it would be a real issue, but not later on, because they're already in big profits and they know that things can happen up and down, and they've seen it in the past and realised that actually it's only just a small blip. So I'm not so worried about it. It's just new people that are problems.
Yeah, and I think you mentioned something really interesting there, where you talked about like when you go on a run of drawdown, it's very difficult. I think the way that can be managed to the best degree is to try and educate them in that whole trading process, so that they're fully aware of that is just a normal part of it. Because as you say, you start sweating, don't you? When it's like jumping off a cliff with a paraglider, you go down first, don't you?
Yeah, exactly. Please catch me.
Yeah, and it's in those moments where then your psychology, you're not just dealing with your own, you're dealing with theirs, and it's very challenging. So.
Yeah, and managing people's expectations is always good, because you say this is a very way of, it's not just investing or whatever, but I'll use the analogy. You often seen stock markets go up and down, and any of these guys that I'll be doing it will have had money in the stock markets in the past, so they'll have seen big ups and downs. So it's only the same as that. It just happens to be on a more probably frequent basis, and that's all it is.
Did you use any sort of biofeedback machines to try and understand what was changing? No,
I didn't. Which I think it would have done it. I thought I expanded it out further. then yes, I think that would have been useful. But no, I didn't. In fact, I kept it to a fairly small amount of people that I did this for.
Right. And you just understood once your own physiology had sort of normalised back to what you were doing on your own kind of thing, that you were comfortable again. Okay.
Yeah.
Fascinating. And you mentioned drawdown there, Simon. What do you have a number of what was your worst drawdown back to back within your profitable career?
Yeah. Just think, what would it be? Yeah, not an exact figure, but somewhere about 18 or 20%, I think, would be about the sort of maximum that I've had as a drawdown period. And that was a particularly nasty period where the Japanese yen just wouldn't stop weakening for a period of time, and I was caught in a couple of trades that I was convinced were going to go in my favour, but they just kept on going the wrong way, and so I stayed with it much beyond where I should have. Actually, I was being married to a position a little bit, and I shouldn't have been, and so I should have got out of them, and didn't, and so I had that drawdown there, which in recent years then very, very small drawdowns, certainly no more than 5%.
Right. Okay. And in that bigger drawdown, so once you'd obviously closed off your positions and you saw where you were, what were sort of your experiences of that? How did that impact you going forward, or did it, or were you able to remain true to the process? How did you do it?
Yeah, it did. Like, I think it made me second guess myself a little bit, but I knew that I was making a mistake by staying in it, and so eventually when I did close it down, I did manage to get it back a little bit. It did start coming in my favour, and I added to the trades and sort of came out. So I did another position in there and didn't make a profit, but it was only a relatively small loss in the end. It was in a fairly big drawdown of say 18-20% at one time, but it was not. I didn't close it out at that level.
Right.
And so when I closed it was a cathartic experience. Actually, thankfully I'm rid of those trades now. I felt really good about things, actually, even though I'd realised a loss, and actually crystallised a loss. It was still a cathartic experience. It made me feel that, let's move on and just make sure I do exactly the right things in the future going forward.
Okay. And can I just clarify, when you were taking trades back in, it's a very different. So on the face of it, someone might say, well, Simon's dollar cost averaging, that's the dangerous strategy. But can I just clarify, you weren't just doing that randomly? There was a big difference between the two things. And
absolutely, yeah. And it's something that you need to be, I think, pretty darn certain that things are going to go in your favour again. And on those second trades that I put in to add to the positions, then I'd got a fairly tight stop loss on those. So if they didn't work out, then they weren't going to cause me a lot of damage. And otherwise you could be left with a huge position running away from you, and then it gets very serious. So no, they were very, very key levels that had reached. It was going to be one where I got a really, really good resistance, because the price of the pairs were going north. I got really strong resistance and a lot of confluence with Fibonacci, trend lines and moving averages that all together that thought, well, if it goes through here, then fair enough. I'm completely wrong about the market, but it didn't. It came back down off those, and so I managed to get out of the trades with not too much hurt.
So that's super interesting. So not only did you take a brand new trade in isolation, so just to clarify, what wouldn't be sensible and what is extraordinarily dangerous is if you just randomly take in those bigger positions as the price just arbitrarily moves against your position.
Yeah, I mean, fundamental that is there that you're just going to be, you're going to have your account wiped out if you do that. Yeah.
Yeah. So you actually waited, just to clarify for everyone, you waited for a statistically independent brand new event, but not only that, you doubled down on process and made damn sure that if you were going to do this to manage out of the position, you were going to do it with every bit of confluence you had available to you.
Yes. Yeah, that's absolutely correct. And as I say, coupled it with a fairly tight stop loss that allowed me to, if I'd read it wrong completely, then I was out of that, and it wasn't going to cause me too much damage. It's going to be annoying, but not too much damage.
Wonderful. Well, what a fantastic couple of interviews we've had. I've thoroughly enjoyed it. The value that you've provided for people has been off the scale. I doubt that there is a better trader anywhere in the world who has just divulged the extent of information that you have. So it's very kind of you, and I'd like to thank you on behalf of people who will be watching this, who've gained a great deal from your experience.
No, pleasure, Mark. Thank you, and I hope people do sort of benefit from it. If they do, then I'll be very happy. Yeah.
Brilliant, Simon. Wonderful speaking to you. Thank you very much. Take care.
Thanks, Mark. Cheers.